Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 221st podcast VideoCast for the week ending January 10th, 2024. Happy New Year, of course. We'll kick it off with some of the family stuff and then move right down to business. First off, I want to congratulate Mimi and her team were featured in Skip Shot magazine, which is the official publication of USA Water Polo. And there they are there. So pretty exciting stuff. Moving along, this was going into do Charles Payne on Monday. Never gets old. And I know there are a lot of new viewers, so I'd like to give the behind the scenes look for those of you who have never been in studio. Charles records Monday through Thursday out of the same studio as a very popular show on the sister network, Fox News, called Gutfeld. They have super high ratings on that network, so it's the same green room for both shows in that big studio. Moving along, this was with Charles Payne on Monday. I want to thank Charles, of course, and I want to thank Kayla Arestivo and Nick Palazzo for having me on. We're going to tune in here.
All right, so last year, that seasonality thing, remember the seasonality map? It was golden. I mean, if you followed that, just filter out everything else, just didn't listen to any of the noise, just watch seasonality, you would have made a fortune. This year, seasonality says that you must be invested. And here's the thing, apolitical voters probably are torn over who to vote for. It won't matter with the stock market too much, although I will say recent history suggests that a Republican elected, the market will go up twice as much. Still, it means that you want to be in this market. However, that might get confusing because there's another set of data that suggests that if the incumbent wins, the market's up, but it's up even more. So I want to bring in now Great Hill Capital Chairman Thomas Hayes. And Thomas, you like this presidential pattern, right? To really, it's going to work again, you think?
I think so. I think the average return since 1928 for an election year is 11.28. Sitting president, 13%. I think this is the pause that refreshes. Everyone's looking for the big correction. Everyone taking tax loss selling. I think it's going to surprise everyone again. New highs before we get a normal correction and a more subdued year, right. High single digits, low double digits.
I mean, it is interesting, though, because in the beginning of the year, there is a little bit of turbulence, particularly when the incumbent party is going to lose, right? So, and that part, maybe it's telling us, there could be a new person in the White House. But this also is because, a lot of money comes into the economy, right? I mean, you're trying to, it's not a chicken in every pot, right? It's like something a little bit closer to Oprah, a Tesla in every driveway. I mean, the incumbent party is going to pour a ton of money into this economy.
Yeah, and look, we've gone straight up for 9 weeks. We had to take a little bit of money off the table the first week. But no matter how this winds up, you're going to wind up for the year. High single digits, low double digits. What's the difference? The key is the money's going to be made under the surface.
The bottom line is you want to be long this market no matter what political party in, and it might help to be apolitical if you want to make money.
That's right. At the end of the day, you want gridlock. You just want one party to win one of the branches so that they can't get much done in Washington. That's a good thing for business.
All right, let's talk about sentiment for a moment. Everyone bellyaches about the individual investor being too bullish. I thought that November pivot from the individual investors was smart. It was brilliant.
Yeah.
They got in. They got bullish before Wall Street did. This is the most recent, one of the most recent from the Bank of America sentiment among money managers. So it's sort of right in the middle, but it's not, it's not roaring sentiment. Does this mean they have to play catch up then?
Yeah, institutions are still relatively pessimistic. You look at they're just as low as they were coming off the great financial crisis.
Right.
And the COVID thing before we even knew that there was going to be a vaccine. So institutions have to catch up. And to your point, the retail investor is the one who got it right during COVID. They were buying well ahead of the institutions off the COVID low, and they made a ton of money into 2021. I think we're seeing a similar situation right now.
All right, we're talking about historical patterns. Again, percent of the time that the S&P outperforms the market. Now, this is associated with rate cuts.
Yep.
This half of the chart, folks, is before the rate cut. This half is after the rate charts. Everything does relatively well, but you like a couple on here. You like energy, for instance. I know that.
Yep.
Energy's getting hammered today. What's going on there?
Yeah, so this is a seasonally weak period for energy into February. I think coming right out of the cuts, we like energy and we like consumer discretionary. You can see here straight away, this is where you get maximum outperformance. You've also seen everyone was bullish about energy last year after you had the huge run in 2021. Now people are pessimistic again.
So 1 month after the cuts, consumer discretionary is usually up 89%, blowing away the rest of the field.
That's right.
Wow. Amazing.
That's right.
Let's talk real quick then about some of your picks. You had some grand slams.
Yeah.
Going back to last March, you had some grand slams. Bank of America, 19%. Google, 35%. Amazon, 45%. What do you like right now? We only have 30 seconds, but give us 2 more. Now the pressure's on,
All right.
man.
Turn around,
the pressure's on. Was it a fluke? Was it a fluke?
Turn around, Tom. It's back. We've got a crazy one for you. Canada Goose, okay?
Yeah, I've been buried in that bad boy for about 9 years.
Okay, so this thing is down 85%. It's down on inventory concerns. Their margins are expanding, up from 52% up to 68%.
Oh, I just thought because Drake wasn't hot anymore. What else you like?
Well, this thing, they've got a plan to grow revenues from 1.2 billion.
But you also like Comstock, too.
I like Comstock. Jerry Jones owns 65% of the stock. He owns it at $7. You can invest pari passu with him. Everyone's pessimistic.
So what's going to do better over the next 3 months, Comstock or the Cowboys?
I'll tell you, Comstock over the next 6 months, the Comstock will do better than the Cowboys. And Jerry Jones said that his holdings in Comstock were worth more than the Cowboys in intrinsic value. So we like that as a double or triple over the next 12 to 24 months.
All right, you got an amazing track record. Happy New Year, my friend. Appreciate it. All right, folks, coming up, a company that is thinking.
And we're back. So we gave a couple new picks there, which we covered extensively in the podcast last week and the week before, as well as general market outlook. Also want to thank Ankika Biswas and Johan Cherian for including me in their article on Reuters today. And a couple quotes. I said, unless you see inflation coming higher than expected, which is unlikely, there's going to be an inclination to move sooner rather than later on rate cuts. And the second quote was one of my go-tos: the secret to happiness is low expectations. And that exactly what we have going into earnings season. Earnings expectations were for 8% as of growth as of September 30th, 2023. They've lowered them to 1 and change. So this is not a bar that needs to be jumped over. This is a bar that can be walked over, and that sets things up for good stuff to come. And I love the fact that the market's a little bit sloppy into earnings season. That should be positive. Money Show 2024 top picks. They asked me to be part of this. There were 50 experts that gave 90 stocks. So you can go to hedgefundtips.com, click on category featured on, and you can see all the picks here and the explanations of why these people have chosen their picks. I included VF Corp and Baxter in this publication, and you know that we've covered those pretty extensively in the last couple of months. Baxter really started to take off in the last couple of weeks, which is nice to see. Also, I will be doing the Money Show Virtual Expo for accredited investors on Tuesday, the 16th. You can click here also under featured on in categories. So you just go to categories here on the right side, click on featured on, and that's when all this stuff comes up. And you can register for free. Other speakers include Bob Dahl, who's legendary. Billionaire Ken Fisher is going to be one of the speakers. John Hilsenrath was Ben Bernanke's whisperer prior to Nick Timiraos being Jay Powell's whisperer at the Wall Street Journal. My buddy Mike Lee, who you always see on Fox Business, along with Luke Lloyd, who's a regular on Fox Business as well, and many more. So you can register there and see all these great speakers at no cost to you. Also, the following week, the 23rd to the 25th, thanks to John Najarian, who you saw on the podcast a couple of months back after we were both on the Claim and Countdown on Fox Business together. Through him, I was invited to speak at this Sequire Investor Summit. And this one, I just want to pull up here we go. This one is run by Chris Maglino, who's been so nice to cover everything, to get down there and speak with some of these legendary speakers. Peter Schiff, I know very well. His Connecticut home is a town away from ours. Our wives are very close, and we've been friends for many years, but he spends most of his time in Puerto Rico now, so looking forward to seeing him down there. And then John Nigerian, of course, new friend, which is exciting to see. And you can see many of these other familiar faces. Bryn Talkington, she's often on CNBC. Brock Pierce is a well-known Bitcoin, I believe, billionaire guy down there, and I think there's going to be a big party at his house. So I think you can still register for this if you're going to be down in that area or have interest, but the website is puertorico.srax.com. So definitely looking forward to that, and going to try to play Dorado while I'm down there. Moving along, this is Warren Buffett. Investors should remember that their scorecard is not computed using Olympic diving methods. Degree of difficulty doesn't count. And I think that's what we try to do here is simplify things. We don't have to see around corners. We don't have to guess the future. As a matter of fact, I want to bring up this one Ask Me Anything question early that kind of stood out for me, but it really stuck in my head. And this is from Michael Starr, and I'm going to read it word for word. Tom, what the hell are we even doing here? ? We can all argue all day long about business fundamentals and buying productive assets, etc. At the end of the day, the clowns want to buy Bitcoin and whatever hot story they can drive to the stratosphere. Bitcoin ETF, what a cancer. If one is so stupid to not know how to buy actual real Bitcoins, then you definitely should steer clear of Bitcoin ETF. Would it not be better strategy to anticipate what the clowns would be interested in next? Maybe psychedelic stocks. I can make some nice stories around that. I am honestly upset that the stock market and me not being able to YOLO into whatever is going up. Show me one stock that makes sense over the long run. Okay, maybe Coca-Cola. Fair enough. What else? Nvidia yesterday, 10 billion market cap, tomorrow 5 trillion. Why? Why even spend time when every random YOLO portfolio outperforms? Where do you get the motivation to stick to public markets? So here's a guy that probably had too much leverage in his portfolio and blew up. But the reason I'm bringing this to you, and I hope he put a fake name, but even so, it's a common enough name. I think this is kind of interesting. You know, there's a term in Wall Street, it's known as the buy side and the sell side. The buy side are people who have to do work because they are responsible for other people's capital, and their job is to earn returns on that capital. And if they do a good job, they're given more capital, and they grow a business. And they're accountable, and there's no way around it because you get marked to market every single day, and you have to know your stuff. There's another side of Wall Street called the sell side, and those are two different skill sets. The sell side's job, if the sell side comes to you and says, I want to sell you this company called PayPal, it's down 85%. Alex Chris is the new CEO. He had a 33-bagger in Intuit. He was responsible for 50% of the revenues, 12% free cash flow yield, growing cash flow, margins reaccelerating at Braintree is the story to get the recovery, which is starting to happen. 435 million users, 1/10 of global enterprise spend, et cetera, et cetera. And you say, wow, thank you very much, Mr. Goldman Sachs. Thank you very much, Mr. Morgan Stanley. That's a brilliant idea. I think I'm going to buy some. But what do I need you for? I can just buy it in the open market. So what Goldman and Morgan do, and other banks of that ilk, is they have to sell something. They are the sell side. And when they're selling something, it has to be new. It has to be a shiny new object, has to be a shiny new story so they can get 6 points raising equity, or a few points raising debt, or fees in perpetuity selling Bitcoin in a different package. But at the end of the day, they're not your friends. So, and by the way, we're going to learn about that in an interesting story about the Bass family and their Disney shares in just a little bit. But the sell side is there for no other reason. They don't have a responsibility to make you money. They have a responsibility to sell you stuff. That is whether it's Bitcoin ETFs or psychedelic stocks. But to answer your question, would it not be a better strategy to anticipate what the clowns would be interested in next? That's what 90% of traders do. And that's why very few of them wind up on the Forbes 400. The type of people that wind up on the Forbes 400, like the Bass family, like Warren Buffett, like Lee Cooperman, like Carl Icahn, the ones that make it there and stay there, Richard Rainwater, who we're going to talk about, Bill Ackman, and many others, Dan Loeb to an extent, David Einhorn, and on and on and on. These are not day traders. These are not folks that are guessing what the next clowns would be interested in next and rolling the dice and trying to gamble and predict and all that nonsense. These are people buying durable, sustainable cash flows when they're on sale, more or less, and to a greater or lesser extent. And that's how they create wealth over time. As a matter of fact, Rainwater, the first $5 million that he was given by the Bass family, he blew up. It turned it into zero because he didn't understand these principles, and he was caught up in the emotion like Michael of guessing what was next, thinking he was going to find the next cancer cure or whatever it happened to be, versus once he got a hold of Graham and Dodd and learned how to value a business and do proper fundamentals and actually do the work, which very few people are willing to do, that's when he got rich. So why do I do it? Because it's created my lifestyle. It's created an unbelievable outcome for me and thousands of others who have been willing to learn and do the work and be patient. And the other thing that I wanted to kind of share on the basis of what Michael is talking about here is you have to know yourself. Know thyself is the famous thing, I guess Thoreau or whoever said it. And, this type of impatient, emotional, excitable personality is guaranteed to fail in this type of business. That doesn't mean it's guaranteed to fail in life. I would bet on this type of person potentially, if they show discipline along with this excitement and energy in an entrepreneurial venture. This is a characteristic of what tends to be a successful entrepreneur. They are impatient, they're energetic, they're willing to do the work, they'll pound through walls. If that wall doesn't work, they'll pound through another wall, they'll pound through another wall. This is the exact opposite of the characteristics and the emotional temperament that makes a great investment, which is patience, steady hand, doing the work, getting unaffected by emotions. If you're an entrepreneur that's totally unaffected by emotions, how are you going to get the excitement to go out there and conquer the world? So, I've had interns work for me that, it was evident that they, part of it is youth, but part of it is DNA. And I've had the talk with them and, they're going out and they're going to accomplish unbelievable things as entrepreneurs and be super successful. But they would have wasted 10 years in the investment business when they're just not wired for it. And I think that for a lot of people, you just have to accept what am I good at and what am I not good at. And someone that writes an email like this, hasn't done the time, either A, hasn't been listening to the podcast long enough and seen, success after success after success with companies. Some happen immediately, some take a longer time. But if you do the work, they just all work out over time. I mean, that's just the way it generally works. I mean, there will be ones that don't, I'm sure. I guarantee that's going to happen. But, and some of the greatest, most successful, wealthiest entrepreneurs, they are self-aware and they know that, and they know what makes me so great and so wealthy in my business, whether it's real estate or rolling up companies or, whatever they do. If they're in biotech, if they're in tech, if they're in software, if they're in the startup business, they know that they don't have the skill set to do this. So they lay it off to someone who that's all they do. And so they can do their highest and best use, which is create new companies, see what's next, create new ideas, create new products, et cetera, and then let their capital grow in the background with someone that has that particular temperament. And that's what makes them so great on both sides, both in their business and with their capital appreciation, because they know how to delegate. So I hope that helps. But my best suggestion on the basis of this, don't spend your time trying to get, like, the implication of what you're saying is, like, find what the suckers are going to do next and do it. That's a sucker squared game, and you will guarantee to lose over time. And the worst thing that can happen to you playing that game is you do make a lot of money really quickly, because then you'll double down and you'll wipe everything out because your mindset and emotional framework is not set for this type of arena, and it can be extremely successful in other arenas. So don't view this as a negative. View this as an opportunity to excel in those areas that you are wired to outperform, even if this domain is not one of the best areas. So I hope that's helpful. Moving along, Carl Quintanilla says, the global disinflation has hit the 2% inflation with a precision on a 6-month annualized basis. The disinflation complete banner is hanging in the hallways of many central banks. That's from New Edge Wealth. And that's the inflation numbers, which we're going to see tomorrow and the day after. Those are going to be critically important numbers as it relates to the Fed, as it relates to equities. And I think that's what the market's kind of waiting for. That, and just to confirm that earnings are going to be okay. But with the bar so low with earnings are going to be fine. This was an interesting article. A third of UBS global wealth management clients are betting on China stocks this year. At the bank's 2024 CIO Outlook in Singapore, about a third of attendees expressed optimism about Chinese equities shining this year in a poll, so you can read that there. This was an article unrelated, but we have a lot of successful business people that listen to this. It was an article about Tom Brady and Wayne Gretzky in Inc.com, how Tom Brady and Wayne Gretzky took competition to a higher level. By the way, I post all the articles I read every single morning at hedgefundtips.com. You can just click on what I'm reading lately or put your email in there and you'll get it emailed to your inbox every single day. And there are a lot of great articles. As you can tell, I read a lot. I take after Buffett. My first boss taught me that because he was good friends with Buffett. We always had 6 newspapers every single morning. And now with the internet, you can do a lot more than 6. So here's the interesting story about that. What is the thing that separated Wayne Gretzky from every other hockey-obsessed kid in Canada? We can start to find the beginnings of the answer by considering how he approached the game. When Wayne Gretzky was young, he sat in front of the TV watching NHL games every night during the season. In his lap, he held a blank piece of paper and a pencil. And as he watched, he'd slowly start to trace. He wouldn't look down at the doodle, just at the screen. But as the puck moved, as his pencil followed, he was charting the path of the puck for the entire game with constant loops and zigzags. At the end of each period, Gretzky would look down and study the movement. He knew that the darkest portions of the page revealed the places that the puck spent most of the time. It's no surprise then, when Gretzky grew up, he had the ability, as many commentators have noted, to somehow skate to the exact same place where the puck was heading. Of course, Gretzky could sense where the puck would be because Gretzky wasn't just a believer in hockey. He was a human. I don't know what that means. He didn't just play hockey. He lived hockey. Wayne Gretzky was a true believer. Work ethic, talent, and luck are all just the byproducts of an unwavering belief in one sport. It's what happens when somebody has dedicated themselves fully to their sport. It's what happens when practice and study becomes a way of life. It's exactly the path that Tom Brady followed to become the greatest quarterback of all time. And, it's funny. People always ask me, why don't you do private investments? I never say never, and I've done some, but the answer to the question is always the same. The prices at which the public markets are willing to serve up businesses at well below intrinsic value never exist in the private markets. I mean, if we were to go into Disney Corporation and offer them $150 a share to take the company private, they would have security escort us out, number one. And number two, they would have eyeballs on us at all the parks and say, watch out for that weirdo. Don't let him into the parks. He's dangerous to the children and other families. Like, he must be mentally ill to think we're going to sell these businesses. Just the parks are worth $80 a share. He gives us zero credit for the experiences, zero credit for ESPN, zero credit for the streaming, which, by the way, now that money's no longer free, all of our competition is falling by the wayside, and we're able to raise prices, and our advertising model is getting better, et cetera, et cetera, et cetera. PayPal, if I came in and say, I'll give you $150 a share, they would have me escorted off the premises. And that just doesn't happen in the private markets. What you get in the private markets is you get a bunch of piece of paper that tends to work really well as fodder for your fire when on cold winter nights in the living room, because they'll give you 5 and 10 year projections and saying, oh yeah, we haven't made any money yet, but in 5 years we're going to be making $100 million a month, and your thing is going to be worth 100x or 200x or whatever. And for every 999 that fail, they write books about the one that succeed. But what they don't write is the books about the 999 that fail. Now, that's also just a DNA thing. I like businesses that are durable, that are proven, that I can buy when they're on sale, and I can know the difference whether they're temporarily or permanently impaired, because that's all I've been doing. I've immersed myself in the game. I love the game. It's all I do. It's all I focus on. So I just don't sway my distraction. I basically do 3 things. Yeah, I do family. I do love watching my kids' stuff. I love doing family stuff. I love just doing what I'm doing, markets. I love doing these podcasts. I love doing the media stuff. But more than anything, I love the treasure hunt every single day, coming into work and making a determination on a company by company basis. Is this a buy? Sell some, sell all, buy some, buy all, or do nothing. And most of the time it's do nothing. And the better you get at the game, the more times, the more higher percentage of time, your answer is going to be do nothing. Not because you're inattentive, but you're more attentive than ever, and you're more experienced than ever to know that the real greatness in this game comes from the game of time arbitrage, which is why we talk about staying away from leverage, because you never get to benefit from the time arbitrage game of buying great businesses when they're discounted on sale and then just playing the waiting game. Some get up to fair value in 12 months. Some get up to fair value in 2 years. Some take 3 years. Sometimes it happens quicker than 12 months. But if you do the work properly and you have the experience, sooner or later, you become like Gretzky, where you just naturally know where the puck is going. Not because we're guessing what's going to happen next and which is going to be the next charging company or nuclear company or anything like that, but buying businesses that have predictable, durable cash flows, a franchise moat, and that you can understand how they operate through different cycles. And kind of along the lines Warren Buffett always said, try to buy businesses that are so good they could be run by a ham sandwich, because one day they will be run by a ham sandwich. And that's kind of how we live by it. This was an interesting article about Daryl Bracken in the Wall Street Journal, and he's the new CEO. We've talked about him many times on the call. VF Corp is obviously a position that we initiated late last year, and he had a 26 bagger when he turned around Logitech, which was down 82% when he came in as CEO. Very similar story to Vans, which had VF Corp, which is Vans, Timberland, North Face, Eastpak, all the JanSport, et cetera, Timberland. And he's spending all his time at Vans because that's the piece he has to turn around. But they tell a really interesting story about his life. Daryl's management philosophy was shaped by childhood trauma. He grew up in the small town of Owensboro, Kentucky. On Christmas Eve, when he was 9 years old, his father left a note on the fireplace mantel telling his family that he was leaving and wouldn't be coming back. After his parents divorced, his mother had 4 car wrecks and a nervous breakdown. Daryl told her to imagine she was on a beach and to draw a line in the sand behind her feet. Everything behind her was in the past. She couldn't change it, but she could learn from it, he told her. And he said, that's how I feel about VF Corp, Daryl said. The past is something to learn from. And the rest is history. He did Old Spice at Procter and Gamble, then he did the turnaround at Logitech, and now we are lucky to have him at VF Corp, and he's going to do the exact same thing. It's wild. If you read through this article, he's giving out his mobile phone to like random employees in the lunchroom because that's where he's spending all of his days. If they turn that thing around, this thing is going to just fly because North Face is flying, Timberland's doing fine, International is doing great. It's basically, the corporate expenses got bloated, which he hit the nail on the head the first day he got there. That was one of their key initiatives. So we're in good hands, and this was a really good article. Now we're going to move on to Disney Deja Vu stock market. And this opening chart here is when the Bass family initiated their position in Disney in September 1984. And as you can see, Disney goes through these multi-year periods of rallies followed by consolidations, rallies followed by consolidations, rallies followed by consolidations. And here we are back at a consolidation. And usually the catalyst to move out of the consolidation is activist involvement. And we have that in spades right now in both Pelts, but more importantly, which got the ball started, Value Act, which came in and just signed a deal with the company. And they were very successful in Salesforce, which we're going to go into this article. So the article of the week, the reason this went out early is because I'm traveling to Dallas for my eldest daughter's Olympic development program in water polo, which she qualified for with some of her teammates, which we're excited about. On Friday afternoon, I will have a window of time open from 11 a.m. to 4 p.m. when I'm meeting with existing clients and new clients. If you are a prospective investor and would like to meet on Friday afternoon in Dallas, Plano, Frisco, or somewhere in between, you can reach out at that link. Or just go to hedgefundtips.com and click on the contact button. So we covered the Canada Goose thing. The other thing is some of the reasons that I've shifted. I know we covered last week why I think the Fed's going to move sooner than I originally thought and sooner than probably most people think, is if you look at the last year of non-farm payrolls, 10 out of the last 11 have been revised downward. And if you add up the cumulative downward revisions, it's about 500,000 jobs. Then you look at the household survey, which is different from the establishment survey on Friday. And there's like 683,000 people out of the workforce. And then, people stop getting counted after a while. So I think that they are accomplishing what they set out to accomplish, plus the supply chains are kicking in. And I think we're going to start to see it in the inflation numbers enough where it's going to push their hand to, at the very least, announce that they're going to discontinue selling so many bonds on the open market, meaning slow down or stop quantitative tightening, which is as important, if not more important, than cutting rates immediately. And the sooner that they cut rates, the less that they'll have to do. As a matter of fact, I think they're not going to cut in January. But if they did cut in January and in March, that may be all they would need to do. Since they won't do that, they'll probably need more than 1 or 2 cuts. They'll probably wait till March. If they're really slow, they'll wait till June. Then they're going to have to do probably 4 or 5 cuts. But I'm just trying to look at here. 2, they have to keep inflation above trend with the debt levels of where they are. We do have to inflate some of this away. If we get deflation, it's too costly to repair. Inflation is easy to manage. Deflation is expensive. You have all the defaults and the amount of debt that we have. The services employment number on Friday also was in contraction at 43.3, which was really low. That is consistent with recessionary periods the last 2 times. So when you take into account all of these as the negatives, that kind of give them more than enough cover to get started with not really becoming accommodative, but just easing the level of restriction, which is now over 200 basis points. Remember, Fed funds rate minus inflation, they're about 200 plus basis points too restrictive, which is contractionary on the economy. And you are seeing bits of that under the surface, and certainly in the NFP downward revisions. What's interesting is that the Bureau of Labor, when he was easing and still buying bonds in the face of inflation, the BLS was underreporting the non-farm payrolls to approximately the equivalent amount for, again, the year that he was over accommodating, meaning he continued quantitative easing in the face of inflation. Why? Because the BLS was underreporting for over a year the number of jobs that were being created, just like they've been over-reporting for the last year the number of jobs which have been created, which has caused him to hike so aggressively and so quickly. So I think he's got a very fine needle. If he does it right, he can declare victory, and we're off to the races. And I think many central banks are starting to get that message as we're starting to see more and more cuts around the world. But he now has well more than enough cover to move on. So in 1969, Sid Bass had been put in charge of investing $50 million from an oil and gas fortune built by his father, Perry Bass, and Uncle Sid Richardson. So this is deja vu Disney. I'm trying to show you in this story how history repeats. And when you have durable companies, it becomes more and more predictable each cycle. Now, in 1984, Sid Bass, through and with his hired investment manager, Richard Rainwater, had built a stake in Disney worth $300 million. You can see chart above. I have heard two things, 487 and 300. We'll get into the dynamics of it. It was part cash and it was part in kind, and we'll tell you what the in kind was and how they got shares in exchange for something other than cash. But this is basically September 1984. The company, it was 16 years after Disney's death, and the company had kind of lost its way, was going sideways. A few activists were starting to circle around. We'll get to his name. And Steinberg, Saul Steinberg, I believe was his name. So they put up $300 million cash, wound up with 25% of the company in September 1984. The company absolutely took off. But what happened was Bass, during this tech boom, got levered up on some of these telecom companies, which were all the hype. They were the AI of the late 90s and the Bitcoin or whatever you want to compare it to. And they got over levered, so they kept borrowing against their Disney stock, which was up it went from 300 million to, I think it was worth $5.8 billion up here. And what happened was they got margin called on September in September of 2001, because they had borrowed against the stock and all their other bets had blown up. So they had to sell their flowers to water their weeds. And the calculation was that they had to sell $2 billion worth. The $2 billion that they sold, which, by the way, they invested $300 million. They got out at $2. I think the total value at that point in time was $2.8 billion. So they still had a 10-bagger, give or take. So, world's smallest violin. They still had a great investment. They still had a great success. They just got caught sideways. And by the way, there's a happy ending. I mean, there's like four brothers. They're all worth $5 or $10 billion each. So they figured it out. It's just fine. But they got banged out of Disney, which he had said at certain points in his life, I will never sell Disney. And he probably meant that. Because if he didn't get banged out, that same $2 billion position that Goldman raped him on, which I'm going to tell you the story in a minute, that same $2 billion would have been worth $20 billion as of September 2021, before we had this recent correction. So that would have been $300 million to $20 billion from 1984 to 2021. which is pretty damn impressive. And it goes to show when you're buying high quality businesses when they're on sale. So there are two stories in that. Number one is buy quality assets when they're on sale. Number two is stay off of leverage so you can hold them forever and not just get the 10 bagger, but get the 100 bagger is basically what it would have been. So that's that. Now, there's a lot of stories in this simple story, other than the fact that we own Disney and we think it's going up a lot. Bass met Rainwater. This is the manager that Rainwater didn't have any money, but he had brains. They met at Stanford. And the first $5 million that Bass entrusted Rainwater with, he lost 100% of it. He then discovered Graham and Dodd, value investing, the intelligent investor, and security analysis, and he became wealthy. And how did he become wealthy? By making his investors, in this case, the Bass family, wealthier. And that's exactly what they did. In 1970, Sid Bass, a classmate of Rainwater, invited him, 26 years old, to manage the family investments. From 1970 to 1986, Rainwater served as the chief investment advisor to the Bass family. He was given $5 million to invest during his first year and managed to lose it all. Rainwater then sought a more methodical investment strategy by studying investors including Warren Buffett, Benjamin Graham, and David Dodd. Rainwater eventually transformed the Bass family fortune from $50 million to $5 billion, amassing $100 million for himself by the time he started investing his own capital in 1986. Now, if you read the Disney story, there's a lot more to it than Rainwater picked Disney and everyone got rich. Sid was intimately involved in the selection and appointment of Michael Eisner and was basically his sounding board and partner throughout Eisner's reign at Disney. So there's more to it, but it's unquestionable. And Rainwater went on to have great returns on his own. But number one, it's amazing they gave him a chance. Then they gave him a second chance, and then he made them even wealthier. And this story rivals the Chandler Brothers story, which we had on over the summer a while back. Philip Vasiliou, the CIO, and the Chandler family turned their $20 million inheritance into $5 billion over 2 decades. In this case, it was 50 into $5 billion, but it ultimately became a lot more in subsequent years, et cetera, et cetera. So, okay, now, Rainwater attended Stanford's Graduate School of Business, where he met Sid Bass, the oldest of the 4 Bass brothers, whose great uncle, Sid Williams Richardson, made millions drilling for oil and natural gas. Bass helped start Rainwater's career. Bass was given in charge of the family fortune by his father, Perry. Following year, Bass invited Rainwater to join him. Rainwater had spent 2 years working for Goldman Sachs, part of the time selling securities in Dallas. Now, this is very important. And this is evidenced why you can't get too mesmerized by a business card. Because what this article correctly states was he worked for Goldman Sachs. That's true. What it also states is he worked for Goldman Sachs selling securities in Dallas. That's a lot different than being an investor. And the average person will say, wow, that person works at Goldman. Well, they're salesmen at Goldman, and they sell the newest psychedelic drug or Bitcoin ETF or biotech company that's going to cure cancer or whatever. And some of them wind up going to cure cancer, but most of them don't. And that's a completely different game on the sell side than being on the buy side, which is why, although Sid probably thought, wow, he worked at Goldman Sachs, he must be brilliant, I'll hire him, here's your first $5 million, and the guy wiped out $5 million. Why? Because he was on the sell side selling products, not learning how to buy investments, and he figured out quickly after that first big loss, he better learn something, because all he learned at Goldman was how to sell. He didn't learn how to buy. And that's when he came across Ben Graham, Graham and Dodd, Warren Buffett, all the classics, and not only learned it, but applied it, which 99% of people aren't willing to do because they're not willing to do the work and they're not wired from a DNA standpoint to have the patience. which is fine. It doesn't mean they're bad people. They're probably getting rich, building businesses and rolling up companies and doing other great things, or inventing drugs for pharma companies, or writing software that makes billions. But it's a different wiring is really what it comes down to. It's like, just because, Michael Jordan is the best basketball player in the world, doesn't mean he would have been an ideal shortstop for the Yankees, and different skill set. So, so the two sank about 20 million into various investments, and all the early deals lost money. Rainwater sought the advice of investors, including Warren Buffett, growth investing pioneer Phil Fisher, Allen and Company founder Charlie Allen, and studied the work of value investing guru Benjamin Graham. Next, Rainwater and Bass turned their attention to Disney, another hostile takeover target, to thwart corporate raider Saul Steinberg and to get its stock into friendly hands. Disney bought a Florida real estate developer that Rainwater had purchased called Arvida Group for 2.9 million shares of Disney stock in May 1984. Bass and Rainwater increased their stake in Burbank, California Disney to almost 25%. By 1986, the Basses had a pay for profit of $850 on their Disney stake. So what happened was Saul Steinberg was a corporate raider. I believe he was part of the group financed by Milken, at Drexel Burnham. Milken was issuing junk bonds to all these insurance companies, and his sales pitch was, because he was sell side, remember, your risk-adjusted return on this basket of low credits is better than your investment grade fixed income portfolios. And the point was, even if 50% go bankrupt, if they're yielding 15%, your net return is going to be better with the same or less aggregate risk. And he was able to raise billions upon billions of dollars, and he used that billions upon billions of dollars to backstop these guys like Icahn and Steve Wynn and Saul Steinberg to take control of major U.S. companies. And when he pissed off enough people and the establishment, they put him in jail. But prior to that, he made careers. Icahn, TWA. There's a book called Liar's Poker. I think is it Liar's? No. That's the Solomon book. Something Ball. It'll come to me. They used to have at the Beverly Hills Hotel where they'd have their conference, and literally he just minted billionaires with this thing. But Disney didn't want any part of Saul Steinberg taking over their company, so they paid him off to go away. They paid a premium for his shares, and the way that they leveraged him to go away was they diluted his percentage ownership by issuing a ton of new shares to buy this asset that Rainwater or the Bass family owned, which was Arvida, dilute the Disney stock, give the Bass family control because the Bass family was friendly, and then the Bass topped up with a ton of cash to build their position up to 25. They paid Steinberg some money to go away. Steinberg made money, but Disney had friendly partners, and that's what happened. So here's the background of the investment. 18 years after Walt Disney had died, his company was in bad shape. Its stock price had fallen to dangerously low levels because of its poor financial performance. I'm reading this to you. I'm not reading you a history book. I want you to think about the parallels to the exact same things happening leading up to the two activists and Great Hill Capital getting involved in 2023. So all of these things are true. Basically, the stock has gone, it'd been sideways for a decade. So stock price had fallen dangerously to low levels because of its poor financial performance. And corporate raiders were beginning to smell blood. So Peltz, by the way, Peltz, I believe, was also one of Milken's guys that he made Peltz with American Can Company, and Snapple, I believe, was financed by Milken, which put Peltz on the map and made him a billionaire. So followed by the Okay, so corporate raiders were beginning to smell blood. Saul Steinberg was the first to buy up Disney shares that March. This is 1984, which, by the way, Peltz was the first. And then he got out when the stock popped. Then we got in. Then he got back in. And then Value Act came in, along with a tiny other firm. I forget the name of them. Okay, so Steinberg came in. Then Ivan Boesky. When Steinberg made an offer that June to buy the rest of Disney with the intention of splitting up the company and selling it off in pieces, Disney agreed to pay him greenmail, buying his shares back at an enormous premium. So selling it off into pieces is similar to what we hear nowadays. Sell off Disney, sell off ESPN, sell off the parks, sell off the cruises, sell off the streaming, sell off Hulu. Same history doesn't repeat, but it does rhyme. Okay, so they paid him off, which in this case, they did a deal with Value Act, which basically blocked Peltz from getting on the board. Similar story, but the threat was still there. In desperation, Disney turned to the Basses. One way for the company to defend itself was to take on more debt so that the Basses sold Disney a debt-laden Florida real estate company called Arvida, which they had bought the previous year. In return, the Basses got 10%, $200 million stake in the entertainment company. In the months that followed, Sid eliminated the Raiders' influence. He bought up Boesky's Disney shares as well as Jacobs, and in the process lifted the Basses' stake to 24.9%. So that's what I was saying. It was in-kind plus cash. He also insisted that Michael Eisner, who was president of Paramount Pictures at the time, be brought on as the next chairman of Disney, thus beginning a new era in the company's history, in which for many years Sid was its most powerful and loyal shareholder. I remember when Sid was working to get Eisner in, a friend recalls he was so excited. Over time, he gave his friends Disney shares on their birthdays, took his two daughters, Hyatt, now 32, and Samantha, 30, to Mighty Ducks hockey games, and even dragged Mercedes, his wife, to Disney's private Caribbean island, Castaway Cay. He loved that company, his friend said. Sid always said that the Disney stock will be in my estate when I die, says Jim Fuquay, a business reporter at the Fort Worth Star-Telegram, who has covered the Basses for more than a decade. Quote, Sid made no bones about saying this company would be in his portfolio forever. And by the way, that was his full intention, and he'd probably own it all now, if not for that 2001 margin call. And that was because also he had this cowboy come in that was betting on all these high-flying garbage that the sell side was selling and pushing in the late 90s. Tommy Turner, I think was his name, and he got him bagged in Global Crossing and all these go-go stocks that remember, quote-unquote, sell side, that doesn't care what they sell you. As long as they can get 6 points, they'll put dog you-know-what in a jar and call it, the fountain of youth. And so that's what got them sideways. They took their eye off the ball. And that's what that Texas Brothers... Okay, so acquired our investors supporting management. Okay, they bought out Steinberg. All right, now, Sid Bass hired Michael Eisner to turn around the company. Here's what Eisner did. And listen to these points because Iger is doing a very similar plan. Disney CEO Michael Eisner had a remarkable rise within Disney. He joined in 1984. Disney was nowhere near the entertainment juggernaut it is today. The founder, Walt Disney, had died in 1966, and the company had entered into a creative and financial malaise. Sounds familiar. In response, board members Roy Disney, Walt's nephew, and Sid Bass, Disney's largest shareholder, hired Michael Eisner to reverse the decline. Eisner revitalized Disney, partially by putting its abundant assets to work and partially by expanding their footprint. Taking advantage of VCR technology, he started selling classic Disney movies on video cassette. Ladies and gentlemen, this is exactly what's happening now with streaming. Remember what we said when everyone was so down on Disney at 79 and 80 and 81? We said they have the best parks in the business and they have the best content library in history. So all they did was they took all their old stuff and they put it on VCR tapes and resold it again and made a fortune for 20 years doing that. Well, now what do they have? They have streaming, and no one has their content library. They're going to put it on streaming. Everyone's subscribing. Now that the other streamers are falling away because free money is over, they are going to be able to raise prices, increase advertising, and they're going to resell the same old stuff that they sold on VHS tapes in 1982. That was 20 years old then. That's 40 years old now. They'll make remakes. They'll update the color and the technology, and they will sell it again and again and again, and we will benefit as owners. Second thing, he raised the ticket price at Disney parks, gaining more revenue without impacting attendance. That's exactly what they've been doing in the last 6 to 12 months. Then he hired Jeffrey Katzenberg and resuscitated Disney Animation, which produced hit movies like Beauty and the Beast and The Lion King. This in turn fueled attendance at their theme parks and sold consumer products. So this is the aspect they have to work on, is the creativity. And what we're going to see Iger is saying is they're going to do less stuff with much higher quality moving forward, and I think that's going to be key. He expanded hotels and theme parks and expanded parks internationally, opening Disney Paris and starting to work on Hong Kong Disneyland. He led the acquisition of ABC Capital Cities in 1985, which brought in millions of subscribers in ESPN. From 1984 to 1994, which, by the way, they just bought Hulu, the second half of Hulu, and now their game plan is going to be to package that all together, ESPN, Hulu, Disney Plus. You basically have an unbelievable package. Hulu has all the stations, commodity stations. Disney Plus has something no one else has, and ESPN has something no one else has, the number one sports franchise in the world. You get that moat, you package it together, get everyone on it, you raise prices, it mints money. It's like the VCR tape all over again. Why to have only lower CapEx, lower distribution costs, et cetera, et cetera. It's just an annuity once you get it going. Why to avoid leverage? Bass family sells Disney shares to help pay off margin loans. This is from 2021. Brothers Sid and Lee Bass and their father Perry Bass collectively sold 135 million shares in Walt Disney Company for about $2 billion, partly to pay off margin loans or borrowed money from brokerage firms, usually to buy a stock. A spokesman for Sid Bass confirmed the sales, which he said were made, quote, to meet liquidity requirements. Bass family members led by Sid Bass have long been among Disney's largest and most prominent shareholders since 1984, when they helped the company fend off corporate raiders, installed Michael Eisner as Disney's chairman and chief executive. The Disney shares were sold at the below market price of $15 a share. Without elaborating, Disney said that through Goldman Sachs, Inc., it bought $50 million of shares at the discounted prices from what it described as significant stockholders. The company also said that Goldman Sachs had purchased 85 million shares. Goldman then resold those shares in the market at a big profit, by the way. After its peak, the stake was valued at $5.8 billion. Today, it would in September 2021, it would have been over $20 billion. Nonetheless, the Bass family still has made a killing on Disney stock. It bought its original 24.9% Disney stake for just $300 million, according to Clive Bode, the spokesman for the Bass. Now, here's what's interesting. Okay. 4 p.m. Goldman's purchase and resale of the 85 million shares appear to have garnered a tidy profit for the blue chip securities firm and its customers. That is because the transaction was done at a discount price of $15 a share. At Thursday's close, that would have generated a paper profit for the buyers of $168 million. Now, what's interesting about that, and you can't make this stuff up, Disney earlier in the week issued $1 billion in bonds, some of which was earmarked for share buybacks, according to people familiar with the matter. The company has now purchased about 55 million shares of its stock. Goldman didn't know about the impending Bass sale when it sold the bonds on Monday, according to a person familiar with the deal. I mean, this is the sell side for you. So effectively, they knew Bass was in trouble. They told Eisner, issue $1 billion of bonds. They made the underwriting fee for that, which was probably $40 to $60 million. Then they bought the stock from Bass at a discount, made $168 million, sold it back to Disney, the company, in the open and to the open market. They probably made about $200 million. They were probably banking the Bass family at the same time. And that's everything you need to know. I mean, the sell side will sell you whatever you're talking about here, Scott. Psychedelic drugs, Bitcoin ETFs, AI stuff. What was it? Remember that Long Island iced tea company started doing Bitcoin mining and the stock went to the roof, and that deli in New Jersey that had sold like 5 sandwiches a day became $100 million market cap because they said Bitcoin or something. I mean, this stuff happens over and over, and if you don't know history, you're doomed to repeat it. It's just been happening since the beginning of time. But this is just sad and comical. But it doesn't. The story had a very happy ending. At the end of the day, this was a brilliant investment by the Bass family and Richard Rainwater, and it made the family a tremendous amount of money. And you have to give them an enormous amount of credit because Sid Bass was given a relatively small stake, although it was a lot in today's terms, but $50 million. You know, a lot of people would blow through the $50 million. He turned it into $5 billion plus, and actually it's multiplied among many brothers, and they've done incredible stuff, and they're a legendary family in Texas, one of the legendary families in Texas that have taken what one generation did and built upon it and built upon it and built upon it. And those are legacies, and it's a very amazing thing. So, okay, echoes of today. So we started talking about Disney publicly on our podcast VideoCast last year, shortly thereafter. Okay. So here's all of Peltz's plan and his list of grievances, which you can go through on your own, but he's basically saying you've done a terrible job, expenses too high, revenues too low, here's how you change it, put me on the board. Then Value Act came in, and they came in with a plan, and they were friendly, and they're modeling, they believe Disney's worth $190 a share, and we agree. And we came in before them with that expectation, by the way. So what they valued at, they built up their position, and they value, we believe Disney's theme parks and consumer products businesses and their $10 billion of EBIT alone are worth low 80s per share, which was their, basically are in their basis ballpark. The theme parks unit has a high return on capital, allowing Disney to further monetize its intellectual property. Amongst its peers like Warner Brothers, Paramount, and Netflix, Disney is the only one who has this advantage. Moreover, this is a business that is not threatened by technology, but enhanced by it. Greatly enhances visitor experience. The theme park valuation implies an almost zero valuation for the rest of Disney's business, includes ESPN, theatrical movie releases, Disney Plus, Hulu, and its television networks. Like digital news and media, video streaming was greatly disrupted by the internet, and the low cost of capital from 2016 to 2021 afforded streaming companies almost unlimited capital to acquire customers at any cost. Then with rising rates and inflation, the bubble burst in 2022, and there was a massive re-rating of assets globally. Many of the high-growth companies that had easy access to capital now find themselves the most capital constrained, and they've been in a long time. This gives a huge advantage to companies like Disney, which has a market-leading brand and an incumbent business model with strong customer relations. Now that these streaming wars are in the process of resolving and companies are focused on profitability versus acquiring customers at all costs, this means cutting costs and creating growing and sustainable revenue. Now, this is very important. Value Act has experience in both of these areas. At Salesforce, where Value Act CIO Mason Morfitt is on the board, margins have gone from 18% to 32% since he's been put on, while the stock has gone from 130 to 220 in 10 months. Disney has already announced aggressive cost-cutting plan, but it is the revenue opportunity that is more interesting here. At portfolio companies like Adobe, Microsoft, Salesforce, Spotify, and the New York Times, Value Act has advocated for and assisted in created bundles, pricing tiers, and advertising stacks that have led to less churn, more pricing power, higher average revenue per user, and even better advertising technology. Both at the New York Times and Spotify increased their bundles, New York Times with Wordle and Athletic, Spotify with podcasting and audiobooks, and both increased subscriptions pricing. The New York Times stock went from $30 a share to $45 per share, and Spotify went from approximately $80 to $175 per share. Disney has numerous opportunities for bundling, price tiers, etc., and there are many ways this can work out through its present assets, M&A alliances, and licensing, but intelligently bundling its products will lead to more stable and valuable revenue. Based on similar situations that ValueAct has been involved in, this could lead up to a $15 billion of EBIT for the media assets and a Disney stock price as high as $190 per share. We agree. It won't happen tomorrow, but it will happen over time in our view. ValueAct, whose CIO participated in one of the most audacious and successful CEO successions ever when Satya Nadella replaced Steve Ballmer as CEO of Microsoft. Someone that with that experience and perspective would be invaluable navigating CEO succession at Disney. We've covered this Microsoft story 100 times, how the stock went nowhere for 7 years, although cash flow doubled, revenues doubled, etc. And we use that analogy against Alibaba because their revenue is 8x, their cash flow 5x, etc. Stock price hadn't gone anywhere. And then they did, in the case of ValueAct, just that one catalyst change, and then the stock was up 1,500% over the next 7 years, even though revenues and cash flow grew the same rate that they grew under Ballmer. They just got multiple expansion because of that change. And I think we're going to see a similar situation in Disney, because they will also help with the succession, just as they did in the case of Microsoft, which was one of the most successful successions in all of history. So Disney did a deal with ValueAct as of January 3rd. You can go through the chronology since all this activist stuff started happening. And now the Disney plan from the most recent earnings call, first and foremost, their revenues were up 5% and 7% compared to the prior year for the quarter, and for the year up 5% and 7% respectively. They added 7 million subscribers. They will reach profitability in the streaming by Q4 of fiscal year 24. Domestic ESPN revenue and operating income grew year over year in both fiscal 2022 and fiscal 23, demonstrating the value of the sports and power of ESPN brand. Experience operating income increased by over 30% versus the prior year quarter. Growth across all international sites, Disney Cruise Line, Disney Vacation Club, and Disneyland Resort. We continue to aggressively manage our cost base and have increased our annualized efficiency target to $7.5 billion versus $5.5 billion previously. And the reason they did that is they found themselves $2 billion ahead of schedule. They were so far behind, they were so bloated that there were $2 billion of extra costs. They realized they could cut easy peasy, and that's exactly what they're going to do. We expect to grow free cash flow in fiscal 2024 significantly versus 2023, approaching levels last seen pre-pandemic. This continued robust free cash flow growth alongside our strong balance sheet will position us well to address our investment and shareholder goals for the year and going forward. We still have work to do. These efforts have allowed us to move beyond this period of fixing and begin building our businesses again. We have a solid foundation of creative excellence and innovation built over the last century, which has been reinforced by the important recurring restructuring cost efficiency work we've done over the year. And we're on track to achieve roughly $7.5 billion in cost reductions, et cetera, et cetera, et cetera. As we look forward, there are 4 key building opportunities that will be central to our success: achieving significant and sustained profitability in our streaming business, building ESPN into the preeminent digital sports platform, improving the output of and economics of our film studios, and turbocharging growth for our parks and experience businesses. We have already made considerable advancements in these 4 areas and will continue to move forward with a sense of purpose and urgency. And I'm bullish about the opportunities we have before us to create lasting growth and increase shareholder value. So you can see by section, the revenue and earnings growth, and the free cash flow, which is the most important part, grew quarter on quarter, year on year, from $1 billion to almost $5 billion. So a change of, they increased free cash flow by $4 billion year on year in the most recent quarter. So you can go through this pitch deck, but the key is they're going to cut $2 billion more than they thought, which is really positive. They're talking about the new cruise ships that they're putting on, the CapEx that they announced for the park, $60 billion over 10 years, which further enhances their moat. they're back to the basics. All the things that Eisner did, Iger is now doing, and they're going to get the same type of results, and this stock is going to hum again. 70 million subscribers. We're going to be here all night if I go through this, so you're going to have to read it. Let me just go through some of the starred areas. We have realigned our pricing and marketing strategies, focused aggressively on getting the technology right, merged our creative and distribution teams, and restored creative excellence as our singular motivating priority with the content we create. We are bullish about the future of our streaming business, and as you consider the components and the future of the business, just imagine the opportunities that a further combined Disney Plus, Hulu, and ESPN streaming experience could offer us as a company and our consumers. They also gained share in sports with ESPN. They're number one, but they further grew their moat. ESPN Business grew in revenue and operating income in both fiscal 2022 and fiscal 2023. This fiscal year also saw the network deliver its best overall viewership in 4 years and its highest viewership in the key 19 to 49 demographic in the same time period. ESPN viewership was up in each of the 4 quarters as well, maintaining steady success, increased its already industry-leading share of sports viewership for fiscal 2023, and we continue to see stability in ad sales despite challenges facing the broader media industry. ESPN Bet will launch next week through our agreement with Penn Entertainment. We're excited to bring sports fans this compelling new experience, maximizing shareholder value, etc. And the movie's coming out. Over the last 5 years, the return on invested capital has nearly doubled for our domestic parks, and we have seen sizable increase over that same time frame across the total experiences portfolio as well. Not to mention important guest experience ratings we're now seeing at every one of our parks. We expect free cash flow to significantly improve in fiscal 2024, approaching pre-COVID levels. Now on to the general market. You can see here this bull market is just getting started relative to history. You can look all the way back through 1962. This is the blue area. We've just come out of the bear market, and we're now starting a new bull market, although you wouldn't know it turning on the TV when everyone's waiting for the next leg down. This chart we covered from Fundstrat last week, which is the composite stock market roadmap in election years with the sitting president is the blue, which would imply some strength. And I think this strength would surprise a lot of people right now because people are a little pessimistic with the wobbliness the first week. But I think the catalysts are potentially the inflation numbers, CPI and PPI, and then the start of earnings season with such low expectations. We could get this rise up into late January, early February, and make new highs, draw everyone back in, and then start to raise some cash and reload here in March and April if we get a normal correction, which would be consistent with an election year with or without a sitting president, and then ride the wave into year end. This is year 4 of the presidential cycle. As you can see, year 2 is the worst. That was the case in 2022. Year 3 is the best. We had a great year last year. And then the election year is also a good year, but a little bit more choppy. And as we said on Charles, high single digits, low double digits. In the 10-year cycle, we are in the 3rd year, going into the 4th year. So you can see that 2nd year is horrible. 3rd year is one of the best. And then the 4th year tends to be a little sideways to finishing up. And then the 5th and 6th are generally good. So a lot of things to look forward to. Earnings still strong at 244 and change. And then money markets, I know that the bears make the argument, well, you can't look at money markets because all that money came out of bank deposits because they're not paying enough. So people have to go to money markets. That's true, but it's still peaking on a relative basis. And as people continue to lose money by being under the desk last year, earning 4% when they could have been in the market earning a lot more, you're going to see more and more of this money come out of the market, out of money markets as the market pushes higher. And this gives you an indication relative to the COVID lows and relative to the great financial crisis lows, which we've talked about many times. Interest expense as a percentage of corporate profits is near an all-time low, not seen since the early 50s. That will go up, but it's got a lot of runway. Balance sheets are good. And then as far as the China update, which was a great article here in Bloomberg. Compared with bonds, Chinese stocks have rarely been so cheap. At about 8% earnings yields of the CSI benchmark is 5.7% percentage points above the 10-year yield. Since 2005, the gap has rarely been this big. Similarly, the dividend yield of the stock benchmark has risen above the long-term bond yields for the first time since 2005. Of course, that's just another way of saying Chinese stocks are dirt cheap, and there's no shortage of other measures to show that. What's interesting about this Chinese version of the Fed model is that historically it proves a very reliable signal for forward stock returns. There's been 5 previous periods in almost 2 decades that the stock bond yield gap has reached 5.5 points or more, including during the 2008 financial crisis and pandemic in 2020. Stocks rose in the following 12 months, each time with a whopping return of 57% on average. That's the index. That means the good companies are up 100 and 200%, by the way. So you can see the average returns, and this is skewed downward by 2012, which and they're saying that may be a result of a bad data field. So excluding that analysis, the 3-month and 6-month forward return would have been 100% hit rate ratio, and the average would have been much closer to probably 70 or 80% if that feed wasn't in there. So that's huge, and that's 1 year out from exactly what you're seeing today. So we're more bullish than ever. China, but more than that is the highest quality business in China, which is Alibaba, and probably the second highest quality business is Tencent. But we've avoided that one largely because we were always a little concerned about the video games. But I don't think the video games are actually going to be a problem. So if someone put a gun to my head and said you have to buy a second stock in China, I would buy Tencent. But since they haven't, we're going to stick with Alibaba because there are a lot more outs. Fear and greed hasn't moved, and the National Association of Active Investment Managers came down from 102 to 70% exposure, which is good going into earnings, because if they're better than expected, as I anticipate they will be over the next couple of weeks, these guys will have to reload, and gals. So that's that. Okay, after being highly exclusive since 2019 and closed to new investors prior to that, our business expanded to serve an additional tier of clients in 2023. The response we've received since opening up this past summer has dramatically exceeded our expectations. If you missed our opening in early Q4, we have decided to do our Q1 opening for the smaller accounts, the $1 million plus accounts, this week, as a couple that had wanted to come in Q4 but missed it asked to come in over this weekend. So we're letting them in. Therefore, we're going to open it up for everyone a little bit earlier than we anticipated. We're accepting them and opening equally for everyone else waiting since Q4. For details and to see if you're qualified, click there. If you're listening to this, you just go to Hedge Fund Tips and click on Money Management. We anticipate keeping the Q1 opening for smaller accounts, those between 1 million and 5 million, available for the next week and a half. Anyone with 5 million or $10 million plus accounts can always just reach out directly for bespoke service. You don't have to fall into this window, but we like to get all the smaller accounts in at one time. We can, get that administration out and done with, and then just focus on investing for the other 11 weeks of the quarter. Okay, so we got that. Let's go to so the podcast is over. If you want to listen to the Ask Me Anything questions, we're going to start those now. And we'll be back next week, same time, same place. So Sam R. also asked a question. What's your thoughts on a stagnating global economy, which I personally think will occur? Would your investment allocation change to more fixed income? China has a lot of debt, and in a few decades will collapse. Immigration too. No immigration too. Okay, so in a few decades, I don't know how old you are, Sam, but you may not even be alive, so I wouldn't worry about what's going to happen a few decades out. As far as thinking about something, if you're going to send, what I could say about guessing about a view on the global economy without supporting it with any data or thoughts around that is a really dangerous way to invest your money, and it's akin to investing on the basis of your political beliefs. If XYZ is elected, then the economy is going to do great. If XYZ is not elected, the economy is going to crash. It never works, okay? The only thing that we can see empirically is that when you have gridlock, meaning the government cannot do much because one party controls either the House of Representatives, the Senate, or the executive branch, meaning they can block extreme moves, the economy and the stock market does better because government has fettered power. When they have unfettered power, when one party controls all three, you tend to get lower returns in the economy and in the stock market because they do too much, and it's usually too extreme on both sides, and that's not a good thing for business. So, as far as picking your spots based on demography, we agree that China is going to slow down as Japan did. We just think based on where they are right now, they've got another 3 to 5 year parabolic move before that happens. And we want to participate because the last leg of the move tends to be the most straight up. And we think this time will be no different. So, if I had a view, you have to look at global population, you have to look at regional growth. Emerging markets are flying. China's lagging emerging markets, but it's going to catch up. I don't want to play that game. I understand some of the Europe thing, but the macro talk is noise. Buy good quality businesses when they're at a discount that there's such a margin of safety and they're growing cash flow. Even if your macro predictions come true, you're still going to make a double or triple. Pessimistic ones. And God forbid you're actually wrong, which is likely, and the economy does better than you expect it will, which it has for the last several hundred years, certainly in America, then you wind up getting a triple in spite of yourself. So keep an open mind. Anurag Gupta, very happy new year. Here's a tough one for you. What do you think about Illumina? It's a world leader in DNA and genome sequencing. Okay, so Anurag is saying that it's only trading at 20 times EBITDA and it's traded at 50 times EBITDA in the past. I don't play that game. We did Illumina. The only thing that's interesting about Illumina is that Carl Icahn is involved as an activist. But we, as a rule, I know this is a testing company. I think I said last time I would buy this, but I won't because one, we have medical devices through Baxter, and that space is already filled. But genetic testing can also fall into biotech, where we have a big position in XBI exposure, a basket of biotech, so that's working. So this would just be another one. But as far as just like looking at this on a one-off basis, I only invest in biotech in a basket because predicting which drug is going to work or which test is going to be the best, that's a real specialist game, and even the specialists aren't good at it. So you're better doing a basket at the right point in the cycle like we did. Even though it was dead money for a year, now it's taking off, and it's going to continue to take off. Why? Because of deals in drugs, which is what we've been saying for the last year. And now the deals are happening like nobody's business, and the drugs are starting to happen as well. So, why is this not working? LMN. Oh, there we go. Okay. What are you talking about? I am upgraded on this thing. I'm not logged in. That's the problem. Or they logged me out. Okay. I just keep locking me out. All right. Let's see here. Oh, because I'm logged into the wrong Gmail account. Okay. All right. ILMN. There it is. Okay. No, I don't think I was logged into the wrong account. Their software is now working. Okay, that's good. All right. Okay, so let's take a look at this. $23 billion of enterprise value. It's doing $4.5 billion of revenue, which are decelerating, by the way. Don't like that. Starting to lose money. Don't love that. Free cash flows decelerating. Yeah, this business is not going in the right direction. So what you have to convince me or yourself is by doing the work is why is this a temporary impairment versus a full impairment? Why is their profitability declining? Very high. Its core business is recurring with high install base. Appears to be a strong business. Shows inferior. Okay, so they did an acquisition of an early cancer detection company called Grail. Now it's going to divest Grail. Okay, so there's a lot of hair on it. So if you can convince yourself that their moat is not eroding with their core business, what's their balance sheet look like? Yeah, it's not terrible. I mean, I think you're probably right here, but I don't have an edge on the technology. This is not, a bunch of, wrenches and chainsaws like Stanley Black and Decker, or generators like Generac, or, Mickey Mouse rides like Disney. I mean, that stuff is easy to understand. This, someone could come up with a better test and you're toast. But I don't think that's the case here. I do think this is going to work, but you have to do the work and understand that they are retaining share, and the impairment is largely due to this acquisition and disposition headache. And what will the business look like pro forma? And you have to have a thorough understanding before you step in. But you probably have a decent enough margin of safety that it's probably a decent look and worth doing the work. But the work is just getting started. It's not a green light, go buy it. It's a green light, go spend the next 3 weeks researching it. Zivko Kanazariski. Hi, Tom. In the podcast last week, you looked at Fox Factor and PII. I think the best of them is actually DOO, 63% market share. Still keep taking share from Polaris, Yamaha, because they're losing too much money. Management own a good part of the company. They're buying stock. Vertically integrated makes their products better and higher margins. Debt to equity is high. Debt to free cash flow could be a problem if big recession is to come soon. I think I did this one last week or 2 weeks ago. I don't like the business generally, whether it's Polaris or this other company. DOO. BRP, I think. Yeah, I think we literally did this one last week, and I said there wasn't enough margin of safety for me. So you can go back and listen to that. Yeah, we did. I said the numbers look great, and it's still a pass for me. So that doesn't mean it won't work. I just think it's generally not the type of business I want to be in, because I don't have any edge. But everything looked perfect. I think even the balance sheet was good. It's kind of like the camper business, Camping World. Like, the businesses look great and they do well in certain cycles, and then they just never seem to get out of their way. They're kind of like miners. Like, even in the best environments, they just never figure out a way to win. And I don't know why, because it looks like they should win every time and they just never do. So that's just experience. Balance sheet looks a little shaky for me. And if a lot of this stuff is financed, I don't know how much of it is financed. Three-wheeled vehicles, I mean, what are those, 5 or 10 grand? Maybe they're not. Snowmobiles, watercraft are probably financed. Motorcycles are recreational aircraft. Yeah, so I think that's going to be the only issue, is just the consumer financing is a little bit high, but that'll come down. Yeah, it's just not for me. I think your paper analysis is correct and it may work, but my experience with those type of businesses is over time they just let you down, even though they shouldn't, but they do. Steve Taylor, on the next podcast, could you please discuss any useful investor conferences for non-industry professionals, either globally or U.S. based, other than Berkshire? Thank you. I like books more than conferences, but I will say this Sequire Investor Summit, which I covered, but the Money Show is always good if you're a retail investor because you can see 30 speakers over 3 days and find a strategy that resonates with you. So you can just go to Money Show website. But I think the books are the most important thing, and learning from experience, learning by doing. Miles Frazier, Tom, I'd like your insight into Dow Crowd New Energy Group. I know you have reservations regarding small caps and mid caps in China. Keep up the good work. And you answered your own question. I won't touch anything other than Alibaba or Tencent in China because no matter how much you get the financials right, one day you can wake up and it's a fraud. Whether it's Luckin, whether it's a million others. You got to go with the biggest and the best. It's no different than the energy industry. When they crash, you got to buy the highest quality ones because the low ones eventually get smoked. And if you're lucky, they get bought out, but most of the time they get smoked. And the bigger players come in and buy the carcass out of bankruptcy. Richard Giacchino, really loving your podcast. Your investing philosophy speaks to me. I have a question in line with that. You mentioned that you're keeping Intel as a free option, but I wonder if you think it's the best opportunity for returns, all else being equal. I'm keeping 1/3 of Intel. We took profits on 2/3 after a quick near double, and we had huge gains in the options on top of that. So the third is a free option because I believe in Gelsinger. I'm betting on the jockey. I'm betting on his ability with all that free government money to create foundries and compete with TSMC, Taiwan Semiconductor, as well as innovate along the lines of something in the GPU world with the advanced AI chips, which I think if there's a guy other than Jensen Huang that can do it, it is Pat Gelsinger, who was mentored by Andy Grove, who created Silicon Valley. So I want that in there. I agree with what you said recently that you need to evaluate your opportunities each day and wonder how you view Intel versus other investments that would seem to have more potential. This is less about Intel and more about the thought process. Thought process is, I made a ton of money off the investment in a short period of time. I want to keep the trailer on. It's house's money. And if Gelsinger's right, that little trailer could be another 10x. And if it's wrong, it's free money anyway. So that's how I think about that. Similarly, you mentioned Amazon and Alphabet likely didn't take as much near-term upside, but you're still holding them as you like them long-term. How do you evaluate that versus immediate opportunities? Because we're not traders. Number one, a good portion of our clients are taxable. And number two, guessing the short-term moves is not going to help you in the long term. I mean, it's basically like the Bass family getting stopped out at $2 billion, whereas if they just held the high quality business for another 20 years, they would have $20 billion. And so whether Google or Amazon outperform this year or not, it doesn't matter. I have a view that they may underperform this year, but what if they double? I mean, it wouldn't surprise me either. I know I have a good quality business. Whether I get a 33% IRR again on it in the next 12 months, or if it hockey sticks 2 years from now and creates that 33% IRR over the 3 years, it makes no difference for me. I want to own that business. Justin from Montana, you've mentioned you're looking for ways to find more exposure in real estate. What do you think about Clipper Realty? Yes and no. I mean, we had that quick double plus with all the options on Vornado. So I think we'll wait for the next phase of panic around commercial real estate to set in this year when someone actually does go BK, and then we'll pick up some more. I wouldn't buy lower quality stuff when the sector's hammered. Owns management, multifamily residential in New York retro. So this is lower quality, lower end properties. The balance sheet is probably garbage. Let me see. Balance sheet, liabilities. Yeah. I mean, if this is correct, which it probably is, they've got $22 million in cash. They got $1.2 billion of debt. Rents are rising modestly. Cash flow. Yeah, I mean, this is dividend chasing. I'm sure. What's the dividend? 7.14%. These are, the only way I would do these low quality is if you bought a basket of 5 low quality ones, where you bought like this, you bought Hudson Pacific Properties, which has Silicon Valley, but that's been kind of a mixed bag, but that's probably going to double if it doesn't go bankrupt. I think with all these, they're all going to double or triple if they don't go bankrupt. With Vornado, I knew it would never go bankrupt, and that's why we got the quick double. We bought the highest quality when it was in the time of max pessimism. So I would buy these like I buy biotech. Buy 5 of these low quality ones. 1 of them or 2 of them will go bankrupt, but the other 3, it's like kind of like a high yield portfolio. But if you just buy one, you're going to get the one that goes bankrupt. And I don't know if that's Clipper or another, but they're mediocre quality. So thanks. You taught me so much. I consistently share your podcast with friends and family. Thank you for that. That's very important. Make sure you do a basket if you're going to do these little piker plays. Aaron L. What are your thoughts on Monroe, which is an auto repair service business? The company's been paying down long-term debt while also paying a nice dividend. I always find value in VideoCast because everyone else debating things like soft versus hard landing. You're discussing discounted stocks and share investment ideas and opinions, not advice. By the way, I would love to see. Okay, so Monroe. This is where I did a lot of my channel check for Advanced Auto Parts. I talked with several Monroe operators to figure out what went wrong with Advanced Auto Parts and why. I wasn't terribly impressed with this business, but I've looked at this one a few times in past, so meaning I determined it wasn't worth investing a month of research to determine whether I should invest in it. I never, ever look at a dividend of a company. That's like the last thing I even consider. That's whipped cream. So revenues are decelerating. Look at the balance sheet. Cash. Got $9 million in cash, $453 million in debt. Not thrilled about that. Free cash flow. Positive free cash flow is decent. Cash from operations, but it's, yeah. I mean, this has never been a high quality business. I mean, you're basically looking at this for a trade, and I think they're just better and higher and better uses of capital. It just seems like it's stalled out, and they don't have the next growth thing. So you'd have to really spend a lot of time on the conference call. Has there been a CEO change? Do they have a better plan to reaccelerate growth? But this thing's been going nowhere for 12 years, and neither have the financials. So it's kind of just in stasis. And, life metaphor, you're either going forward or backwards. There is no stasis. So if you're not going forward, you're going backwards. And that's why I took a pass. But there may be a turnaround plan, and you just have to go do the work. But from a quick look, I determined it wasn't really worth the work. Tim Strom, since you now dabble in luxury fashion space with Goose, what do you think about Burberry or Kering? Burberry had its stock price collapse, but all the good metrics are on the way up. It's a 160-year-old iconic brand. Kering is similar, but bigger, although some of their brands seem a bit washed out. I don't know about that. Let's just see. Burberry. I think I did Burberry like a month ago, and I passed on it. All right, let's take a look here. Huh. All right, so their revenues I mean, they haven't really grown much in 10 years. What brands do they have now? Just Burberry or? Yeah, I don't know. I think Burberry's kind of dead in the US. I don't really know fashion that well, but maybe it's still big in Europe. Like VF Corp and Goose. All right, balance sheet. I mean, half of it is just understanding, are they going to stay in business until the cycle turns if they're a long-term business, like you say. The balance sheet, I think, is probably decent. Yeah, balance sheet's okay. Cash looks okay. Yeah, I mean, it looks fine, except for the fact that there's like no growth. So the multiple is going to be really compressed if you don't have any signs of growth. Do they pay you a dividend at least? Yeah, 5% dividend. I mean, and the stock is reflecting what I said. It's been going nowhere because there's no growth. It's just basically, so if you want to keep trading it from this range down at 17 back up to 30 for the next 10 years of your life, buy it 17 to 19, sell it, 28 to 31, you could probably make a living doing that. It's yeoman's work, but have at it. Thanks for the tip. All right, Drew Byrne. Hey, Tom, grateful for your thoughts on general subject. Don't worry, not on choosing a partner this week. It's about building a position as timing. This can be very tricky, e.g. balancing too early, using up capital prematurely versus later, missing the best opportunity to deploy. When you give an opinion, not advice, e.g., we may get a chance to add at lower levels in the months ahead. Grateful to know what informs you of that, as your opinions are always so prescient. Do you consider a combination of recent company conference calls, especially the most recent projected future cash flow earnings, specific near-term headwinds for the company, imminent macro picture, blah, blah, blah? I think you're overthinking this, Drew. Just buy something with enough margin of safety. Don't put all your eggs in one basket. We run a concentrated book of 8 to 12. Why? Because things go wrong. If one goes to zero, I'm not taken out in a stretcher. The others are bought with such a margin of safety that I can still achieve my above, outsized IRR over a period of 36 months, even if one went to zero, which won't happen because I do balance sheet and cash flow analysis before we ever buy anything. But I have to assume always that there could be something I don't know that I don't know, which is why I don't put 100% in one basket. So as long as you're not overweight to a level where, one wrong position could take you out on a stretcher, don't overthink it. If it goes lower and you have cash, you can buy more if you're not at your position max. If everything else doubles, which is a situation, then, you'll get to buy more at lower prices if that one's the laggard, because you have to just to bring it up to a decent sized position because everything else has moved up so much. So I wouldn't overthink that stuff. I think if you're buying with a large enough margin of safety, a quality business with a moat, with durable cash flow that's operated through cycles, that's temporarily impaired, and you've done your work, then if it serves up an opportunity to buy more, you do. In terms of Comstock, I said that just because this is a seasonally weak time for usually February. Sometimes you see some weakness in energy. This time might be different, but we'll buy on weakness, and but we love it. We're basically pari passu with Jerry Jones, and we like the long-term secular play, and we like how they're positioned with the terminals in the Gulf of Mexico. So Julian Glock wanted to ask whether you could give a look at Paycom. I think we also did this one in the last couple of months, but we'll take a look at it. All right, Paycom. Yeah, I don't love these because they don't have enough history for me to see. Like sometimes these new software companies, they're just like a flash in the pan. They have one cycle and then they never come back. And I have no way of knowing if this is going to be the one that comes back or not. Now, this is showing me that it continues to grow every single year. So that's a good sign out off the bat, both on the top and the bottom line. That looks good. So my guess is it just got too high a multiple for now rates money no longer being free. The problem with these is when these high flyers break, you don't know how long it's going to continue to break. I mean, because let me just look at something here. All right, P's 25 times. I mean, if they're growing, balance sheet is probably perfect. Let's see. I'll bet they have zero debt. What is this other current liabilities? All right, let's see. Cash flow. Yeah, margins are expanding. Huh. Julian, there's nothing I don't like about it. So it's worth doing more work on it. The problem I find with these businesses is I have no edge to understand whether there's a true moat with software, because it can probably be replicated, and I have no idea how quickly that can happen. This is cloud-based HR. Yeah, it probably just makes that HR process simplified and lower costs, and you can cut a bunch of HR people. So that's a good thing for small and mid-sized business. Question is, who are they competing with? What do they do that, ADP and Paychex doesn't do, and other companies aren't going to try to do? So if you can understand their competitive advantage and why it's durable enough that it's going to stay in place, their numbers are showing me that it's staying in place. So therefore, I think you're onto something. And you could say this is probably just a function of the rate hike, and they fell with everything else, and this business is going to go to the moon. I'm not finding any flaws in it. I mean, I would say this one would take a lot more work than a normal company, because you have to do a lot of qualitative work. It's not just quantitative. You have to really understand the product. And even then, you're going to be wrong, because tech can change so quick, which is why Buffett always avoided these type of companies. Just want to see what the estimates are on this. Yeah, revenues 1.3 to 1.6 to 1.8. Earnings came down a little bit. Their next year estimates came down a lot, 10% in the last 60 days, 90 days. So I want to understand, why is that happening? That's a big drop in estimates. And so 8. So it's like a 25 times forward with 14% long-term growth. So the growth is kind of decelerating. That explains a little bit about it. I'm going to tell you now, it's not my type of stock. I mean, this was a 50 bagger. So it's now down 50, 60%. You just have to be careful. When these type of stocks break, they even if everything looks perfect, it's sniffing out this deceleration. And I don't like this downgrade for such a high growth company, because once they're out, once people run to the exits on something like this, they just don't stop running, even though it looks cheap. This could become a company that 2 years from now is trading at 6 times earnings and is still growing at 12 to 15%, and you can't give it away, and that's when we'll be interested in it. But right now, on paper, you're right. It should just reaccelerate, and it may do that. But I'm not willing to take that risk. But it warrants more work, Jillian. And I think your framework is correct on this. I just, from experience with these type of companies and seeing so many things over the years, and not being able to have a real edge, even though you think you do on this stuff, it's a pass for me. Thank you for all the education you put out there. This is from Denise H. Found you 2 weeks ago and am enjoying your insights. Oh, welcome. And using them to find turnaround opportunities. Can you please take a look at GraphTech International for an interesting commodities play? One of the top 5 graphite electrode producers in the world, a key player in sustainable steel recycling, steel energy. Stock is hammered, looks like a multi-bagger long-term. Chart has a few gaps that could get filled. I don't care about the gaps, but I think I did this one a couple of weeks ago. At least I know I've looked at it like literally 10 times in the last quarter and said no every single time. I think they're toast. If I recall, their balance sheet is done. And that doesn't mean that they're guaranteed to die, because capital markets should be reopening and they might get lucky and refinance. Question is, are they forced to dilute the equity, or do they actually get a debt financing done? And then what does that look like pro forma? So this is why so you have no way to tell what the bottom is. I mean, this thing went from 800 million in revs to peaked at 1.9 billion in 2018. It's back to 700 million. I mean, revenues are down 65%. This is a crap business. I mean, maybe if you want to pick it up for a trade at $2 and hope it doesn't go bankrupt and bounces up to 5 and then get the hell out before the gig is up, then have at it. But that's not the game I play. I mean, share count's coming down. Let's see what's happening with cash flow. Are they at least generating some cash? Yes, but a lot less than they used to. They're down to they were generating $760 million of free cash flow in 2018. Last 12 months, 42 million. Everything is going in the wrong direction here. So unless you have a clear play on the turnaround and some edge, I just wouldn't play with it. When you see revenue deceleration like this, that's a real red flag. And I generally don't like commodity stocks, with the exception of high quality oil or natural gas companies at the exact right time in the cycle. But general commodity producers and miners and so on, they just have an uncanny way of losing money in every cycle. Good cycles, bad cycles, they just figure out how to lose money. So it's a pass for me. I think that it's clever. You're thinking around it, and I think you're on the right track. For me, there's just a little too much risk in this one. But with that said, I want to thank everyone for tuning in this week. We'll see some of you down in Dallas. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.